You have earnings season kind of coming to a close. But there's something that's interesting. As someone who looks earnings season, is my favorite time of year, listening to these conference calls and reading the transcripts and getting ideas and seeing how these guys are managing through tough times and inflation and supply chain issues. The one thing I noticed is the separation in names within the same industry. A lot of times, like COVID, everything went up. Everything went up. Some stocks went up a lot higher than others, but everything, just went up no matter what sector or wherever you were. Almost everything just surged, completely surged. You're not seeing that right now. I mean, look what FedEx reported. Horrible numbers. And look at UPS, great numbers. I thought Google and Microsoft reported great numbers compared to Apple and Amazon. Apple said seeing supply chain disruptions. They're actually cutting iPad. They're going to wind up cutting iPad sales because they need to put, they got greater margins on the 13, on the new phone, and want to put more capacity into that. Amazon, their numbers missed. They're seeing supply chain issues, although I love Amazon. I think it's an incredible buy here. I mean, if you look at, companies get hit a lot of times when expenses go higher, but you have to look at where their expenses are going. And sometimes they're going to places that are going to ensure long-term growth. And I see that so much. CapEx goes higher, they get crushed, margin a little bit lower, and these names get nailed and say, wow, we didn't know costs are going to be that high. And again, it takes a big bite out of earnings, but you have to look what those costs are, right? You have to invest money to make money. You have to invest, whether it's marketing strategy. Amazon here is investing in people. I mean, that's a great investment right now when nobody could hire anybody. Look at Starbucks, what they reported. Anyone who goes to Starbucks knew they were going to blow the quarter, right? They knew they were going to miss the quarter. It's terrible. And I can't tell you how many times I pulled up Starbucks. There's a lap around the whole freaking place in the drive-thru where I just passed. I used to like going there probably 3 times a week. I go there once a week now. And I know I'm not the only one. I don't feel like waiting on that line. And even when I do, they don't have a lot of items that are in. And these are like regular items that are not, that are some of the biggest selling products that they don't have. That results in you going someplace else. But most places that you're seeing, especially restaurants, wherever, they have labor shortages. But Amazon said, look, we're going to invest in our people. And what does that mean? I mean, you're looking at a company that really didn't see that much supply disruption or disruption from the customer point of view. Yeah, there was a few things maybe that came a little bit later than expected. But overall, Amazon pretty much got the job done through COVID. And now you're investing in people at the most critical time, maybe in the history of companies. Not just going into the holiday season, but we have the biggest supply disruptions the country's ever seen. I mean, it's insane. You see it. I mean, companies reporting blowout numbers up 17, 20%, and they're like, we have supply constraints. Imagine what they would be if they can get their products because there's so much demand out there. But now you go into Christmas holiday season. I mean, Amazon's going to kill it as their competitors try to go through this, this holiday period without spending boatloads to hire great workers. I see this a lot. Stocks get hit where they spend more, but you have to look at what they're spending on. It's very important. If you spend on marketing or spending on people, you're spending on, a little bit on M&A, or you got to look at they're spending money in the right areas. That's the biggest area for Amazon. They have to make sure that their systems, everything's up and running. People get those packages delivered on time. I'm telling you, you're going to see a massive separation between Amazon and almost everyone else, the Walmarts, the Targets. Watch during the holiday season. They're going to kill it, and you're going to see that stock really, really soar. I take advantage of Amazon right here. But getting back to that separation, and we saw Intel compared to AMD. Look at Under Armour's numbers. Holy cow. I mean, you look at them compared to lots of sports apparel companies, including Nike, that reported a big inventory shortage last time they reported. Also said, had China weakness a couple months ago. I don't think they reported yet for this quarter, but that was last quarter. And the stock, came down pretty hard. It went to 150, and now it's been creeping higher. 165 right now. The all-time high is 175, even though they reported. So expectations are pretty high. I mean, nice job for Goldman Sachs, which you all criticize. Goldman Sachs initiated with a buy at around 150, and it's 165 already. Good job on that. But that separation that you're seeing is incredible with some of these names. And Under Armour, man, Sales exploded, margins exploded. I mean, that thing's going to get re-rated. That thing's going to soar a lot higher. A lot higher. I'm doing this early. It was up 8% now. I think it's up about 15, 20%, whatever it was. It is right now. But it's going to get re-rated because when you see sales exploding and they raise their guidance significantly, raise their EBITDA, and their margins are going high, what does that mean? They're not seeing the same problems that Nike saw last quarter, other sports apparel makers are seeing, which is supply constraints or limited pricing power. This company obviously has pricing power because its margins are going higher. I mean, that guidance was fantastic. Avis is another one we have in the portfolio. Surged. I think it's going to be a 10-bagger now for us in Curzio Venture Opportunities. Recommend that a lot cheaper. Holy cow, that thing's taken off. Blew out the earnings. I think reported like $10 in earnings or something. They were supposed to put $6. Unbelievable. Unbelievable numbers. But when you look, not everything is benefiting from the COVID rebound or the $11 trillion plus in government spending, which includes fiscal and monetary. So you have some management teams that are getting it done while others are struggling with a lot of those issues, supply chains, inflation. And you have to have pricing power. If your costs are going up, which they're going up for every single company in the world right now, you have to be able to pass those costs on to your consumers. And if you can't, look out. Dollar stores saying that they're going to start selling most of their products for over $1. Do they have pricing power? People go there to pay $1 for stuff. I don't know. I think McDonald's has pricing power. Chipotle obviously has pricing power. Under Armour has pricing power. Focus on those companies. Because these are the names that I see an explosion in their numbers. But there is a big separation going on, and it's pretty cool to watch. Management teams are getting it done, and some aren't, but that means it's a stock picker's market now. Not everything is going to go higher, and you have to be careful. So pay attention. For me, I'm seeing lots of good ideas, especially on the small cap front. So you look at small caps, significantly underperform large caps. If you look year to date, 6%. It's close to 10% if you take the past 6 months, where Russell's basically flat over the past 6 months. It surged early in the year. So the past 6 months, if you wonder, well, my small caps aren't doing that great and stocks at all-time highs, it's basically flat over the past 6 months versus a 10% gain for the S&P 500. But if you look under the hood, which I say that a lot, and I love the Russell. I've been following this small caps. Love it. The majority of my career is what I did. Stocks Under 10 newsletter, you guys remember? At street.com. Kramer ran that newsletter, that product. But when you look at the comparison between large caps, small caps, the difference is much greater when you look under the hood. Since most of the gains in the Russell have come from the larger names in this space. And you can say, well, the S&P 500, 20% is FANG and stuff like that. This is different. This is different. I mean, wait till I break down these numbers. So you look at the Russell. The Russell rebalances every year around June. And in May, they come up with their guidelines. And it's pretty easy to figure out. May, if you fit in those guidelines within those market caps, you're going to go in. And if you're higher than it, you'll move up to the Russell, 1000. But the $7 billion was the high range, which is extremely the highest ever. Right? I think it was $5 billion last year, but $7 billion was the high range. So we had a company that was $7 billion market cap. That was back in June. As of right now, today, this is only June. There's 35 companies with a $7 billion plus market cap that are trading in the Russell. This includes Asana, which is a $25 billion company. AMC, $18 billion. Avis was $12 billion before this 40% move, so it's probably like, close to 12, 17, 18 billion now. Crocs, $10 billion. Macy's, $8 billion. DigitalOcean, $10 billion. And these names alone, those names I just mentioned, probably have a bigger market cap than the last 1,000 companies in the index combined. So where am I going with this? If you're looking at the performance in the Russell, it's mostly driven by those top companies. Again, you can say the same thing for the S&P 500, but this is much more concentrated. And these companies account for, these were like the FANG names in the Russell, they account for more than 50% of the total market cap. Well, you're looking at 20% for the S&P 500. But even if you take the top 25, 50 companies, 50 companies in a Russell, you're looking at 2 or 3% of the entire index. That's being driven there by those larger names. with many smaller names in a Russell outside of banks and energy, two sectors that have done incredibly well this year, especially later on in the year, are significantly underperformed. If you want more proof, the Russell 2000 index up 17% for the year, yet 40% of the index is showing losses on the year. In fact, close to 60% of the index has underperformed the overall index. It shows you it's very heavily weighted on the top. So I'm seeing lots of underperformers, companies that do have pricing power, good management teams. They reported solid earnings. A lot of those earnings are coming out over the next week or two. Mostly the large caps are just about done this week. You'll have more next week. But the majority is done for the S&P 500. Now it's small caps. Now it's fun. But you're seeing some of these names just starting to benefit from the reopen tree. Names in the travel industry, yeah, they rebounded, but they're not past their COVID highs, their pre-COVID highs. Biotech has gotten murdered. Furniture, retailers, restaurants, fast food. Some of these names rebounded. Yeah, you're going to hear about the Chipotle's and some of the other ones, but, Steak and Shakes or whatever. There's a lot of names that have significantly underperformed.